Right. Morning, everyone. Welcome back to Morning Kappa at 8. Aiman here. Okay, so if you look at the S&P 500, well, it formed a bullish hammer candle on yesterday's session, rebounding from these 20-day uh, SMA lines because buyers stepped in late to defend the support level after the Fed which book reported a modest growth and cooling labor markets. I think this is a perfect soft landing signals as well. So the reversal was, I think, led by the big tech names as investors decided to hold quality stocks ahead of the CPI data, betting that the numbers will be enough to keep the bull momentum ahead. So I expect the bullish momentum, bullish movement, right? Uh, on the good CPI data today. So also the hammer candlestick pattern confirms that the deep buyers are still in control and are betting on the positive market sentiment as a whole. So if you look at our US trading stocks that were published overnight for today, for today, right? We got here Boeing, BA, stock code BA. So yeah, the stock is experiencing a breakout at $235 level, and now we can expect the stock to propel to travel higher to its the $255 level on a strong momentum, followed by the next resistance at $280 level. So now if the counter reverse, do watch out for $220 level for the immediate support, which also could indicate a potential initial trend reversal signal, right? Also, next we have SLB, also stock code SLB. If you look at the charts right here, also the the stock charted a high market structure, forming a higher low formation, breaching this $45 level, eyeing to reach higher towards the $48 level. So if the stock to climb up higher, we could see that the stock to travel towards $51 level. Now if the stock to slide lower below this 42 $42 level, this might signals a shift to a bearish structure, right? So looking at the China A50 futures, right? Yesterday, it dropped and failed to hold above this 15,500 resistance level on Wednesday session after I think regulators raised the minimum margin requirement for the stock purchases to 100%. I think from 80% initially, right? So effectively cutting off the leverage, the easy leverage for traders to cool down the market. So I think this is one of the tighter effort to tighten the risk control in the equity market, which also signals that the regulatory wanted to slow down the market a little bit, right? So I think sentiment was also dampened by the news that the China Vanke is seeking another extension on its bond repayment, keeping the property sector alive. So I expect I think for today, expect a reaction from the trade data, and also um, in terms of technical charts, right? I noticed one thing here, uh, which is the index charted a potential reversal pattern of double top right here. So at this juncture, a minor uptrend still holding strong. However, if you see that the price if this price starts to test and close below this trend line, we know that the next target is the support of 14,700 level points level, right? So, but yeah, before that, we need to see how's the reaction at this psychological level of 15,000 level first, before this index move towards the 14,700 level, right? So if you look at the WTI crude oil futures, well, It closed sideways yesterday as the market, I think, digesting between the sentiment of weather models predicted a polar vortex hitting the US next week, uh, which to me, how we see it is that it will spike the demand for heating oil. And also the weekly EIA report showed that the US oil production jumped to a record high of barrels per day, which also signals that there is a plenty of supply to meet the demand, which also cancelling out the weather fears I mentioned just now. So I think the market are now for today, we the market are now expecting for a choppy uh, trading session, right? Probably between $62 resistance and also 58 dollar support, uh, and waiting to see if the winter storm actually shut down the production. However, for now we still keep our view or our eye at the bearish side of things until it crosses above this stop loss of $62 level. So at this juncture, we're aiming at the 58 together with the 55 uh, support level. So looking at the Malaysia market, well, for yesterday, Bursa Malaysia closes higher, right, on Wednesday session, led by buying in blue chips, also a firmer ringgit and a positive regional Q. So I think the index hit the best level for quite some time, right? Helping the FKLI to close stronger as well. So I think investors are watching for the incoming GDP data and also global macro signals for the next uh, market direction, right? For the next clue of market direction. So I think the overall sentiment was boosted by the broader market flows and also the currency strengths. And also for the FKLI traders, uh, sentiment for Malaysia, I think market remains strong. So we see that I mean, we saw that it formed the market has formed a higher high market structure, and now we can see that the index holds firm above this psychological level of 1,700, and this could potentially move higher, pointing towards this 1,730 points level. So uh, now, I think a new thing for you guys today, which is the elite wave, right? So, I saw that the current wave could be the last wave for this cycle, which is the impulsive wave 5. So, hold on. Okay, yeah, this chart. So pointing at I think at this point, right, we do not discount any retracement to happen at this 17 1730 and also 1750, somewhere around this level, which align with this Fibonacci projection level as well. So yeah, I think for those of you who are new to elite wave, well, it's a market structure where price move in a five wave along with uh, three corrective wave. So yeah, I think, well, if you are interested to know how I detect this elite wave or the wave itself, maybe can join my Bahasa event next week, right? So yeah, I think one stock that I saw that have potential to benefit from the current bullish movement or bullish sentiment, which is this stock, which is Ramsol here. So from yesterday's move, it has breached above the consolidation move or the sideways pattern to surge higher, right? So looking at the technical indicator now, the MACD has crossed above the signal line together with the spike in uh, volume as well, and also supported by the RSI holding firm above 50% mark. Right. So moving forward, if the bullish remains strong, I think we are looking at the resistance of 1 ringgit and 7 cent. 1 ringgit and 10 cent, and also 1 ringgit and 14 cent, referring to this projection, Fibonacci projection level. So this is our watch list for today. And for the trading Malaysia trading stocks, we have EG, right? So the stock has breakout higher above this 1 ringgit and 15 cent level on a strong volume, right? So with that, we expect the momentum to keep bullish and bullish, and the stock able to propel higher to test the next resistance at 1 ringgit and 22 cent, followed by 1 ringgit and 30 cent level. So if the stock to clear this 1 ringgit and 80 cent support, this could reverse the cost to trend lower, right? And also fundamentally, this is also aligned with our analyst Queenie been targeting, and somewhere around 1 ringgit and 41 cent to 2 ringgit and 9 cent for her fair value that she recommends, right? So I think you can request the reports from your rep. Okay, next we have Celcom DG. So the stock is experiencing a breakout as well at 3.44 level. So if the stock to remain bullish, we are expecting that the price to reach somewhere around 3 ringgit and 55 cent level in the coming session, together with a high volume as well. Second resistance is at 3 ringgit and 65 cent, and keep an eye at the 3 ringgit and 35 cent level for any attempt of reversal, right? For our FCPO, well, it dipped to close at 40 ringgit level on Wednesdays, as Street Consensus lowered its 2026 average price forecast to somewhere around 4,000 ringgit, warning that the massive stockpile will take months, or probably months to clear, right? So sentiment was further dampened by the USDA report, which raised the US soybean yield estimates, which this caused soybean futures to drop as well, dragging the FCPO down despite the positive export number for FCPO, right? So I expect the price to sideways or even drift lower towards this psychological level of 4,000 ringgit level today, as traders worry about the visibility in Indonesia B50 mandate, with the crude oil hovering somewhere around 60, hold on, 61, 62 level, right? So I think that's all I have for today. Thanks everyone. Thanks for listening. Happy trading, and see you again tomorrow. So I pass the floor to the next presenter, Leng. Thanks.
Hi, good morning. Today we've got a plantations sector news flash. More news flow with regards to the Indonesia story. So yesterday we talked about the fact that Indonesia is postponing the B50 mandate. And today, or rather yesterday, they decided to increase the export levy rates on CPO, as well as on refined products. So the export levy rates is now going to be 12.5% from 10% for CPO, and to 10% from 7.5% for refined products. And this will be in order to fund the B50 mandate in 2026. And this will be will be effective from 1st of March 2026. So there was also another confirmation from the Deputy Minister of Energy and Mineral Resources, saying that they will maintain the B40 blend for this year. And that's mainly because of the fact that they're saying that it is taking them a bit more time to complete the trials, especially for trains, heavy equipment and machinery. And as well as that, they are saying that the country's diesel fuel production capacity has also recently been increased, and that was also a factor in the decision. So the new timeline for B50 will be decided once the trials are over. So with the increase in levies, we estimate that that there will be an ability for them to fund the B40, and probably the increase in levies also explains the resilient CPO prices yesterday, given that normally when the levy rate is increased, we would normally see a sort of improvement in the price movement to sort of offset that levy hike, and that sort of kind of offset the negative news on the scrapping of the B50 mandate. But of course, at the same time, the B50 mandate postponement is a negative on the supply and demand scenario. Based on the existing 7.5% rate for refined oils and the current forward spread of about $340 per ton, we estimate that there would have been a shortage of funds of about 448 million USD to subsidize B40 at current levels. And then, obviously with the increase in levy to 10%, we expect that there would actually be a slight surplus of funds. So we've put in the sensitivities of our calculations back in the back of the report in figures 1 and 2. So we will be looking, or re-looking at our price assumptions as well as our supply and demand numbers following these developments. We will also need to adjust our forecast, for this change in tax structure. But obviously we highlight that, the Indonesian-centric planters here would bear the brunt of the higher export levy from March onwards, and therefore resulting in lower effective ASPs. So we're keeping to our neutral sector call. We would prefer at this point the Malaysian-centric planters. So our buys are JPG SOP and IOI Corp. So that's all from me. Let me pass you on to Aidil. Thank you so much.
Hello, hi. Morning, everyone. So today, we'd like to go Pavilion and AME REITs. Back to KLCI, which gained 3%. We still continue to see REITs as a good defensive play amid global volatility. So REITs have good domestic-centric income and as well as good growth trajectory from their earnings visibility. So for the macro setup, it's still supportive. RHB economics expect Malaysia to grow around 4.7%, inflation to stay low at 1 to 2%, and OPR staying about 2.75%. And externally, we see that US Fed has been on a rate cutting cycle, and for 2026, we could expect 2 more rate cuts, and this would in turn shift the this will in turn support the incremental flows to Malaysia and thus drifting the bond yields to be lower. And then on the valuation front, the REIT yield spread is about 150 basis points, slightly below its long-term mean after 10% compression last year. So we still see, despite being below the long-term mean, it's still government slightly and thus widening the yield spread. So I'll go sector by sector. For retail, you should see good improvement this year, primarily driven by VMY and also good consumer spending, driven by the higher disposable income coming from SSPA revision pension scheme, as well as the continued SARA disbursement. In this regard, we look at Pavilion REIT as one of the key VMY proxy. So they have one of the stronger variable rent rates in their malls, and also that they have acquired their hotels in the hospitality segment last year, which we could see full year contribution next year. And on top of that, with the growing tourism income coming in this year, we would see Pavilion as one of the key beneficiaries. And in regards to the sector-wide for retail spaces. Although we do see that there have been some ongoing supply of new retail spaces last year. So, for example, you have KLGCC Mall, Hexstar World, and also Sunway Square Mall. We note that the retail mall under our coverage are steady and has been doing very well in terms of occupancy. And this shows that despite new supply, malls that are strong, high quality, and very tourism in a tourism link location are stable to all the supply expansion. And just to give a bit of overview, the retail trade sales in Malaysia has been growing 6% year on year since last year. So this would confirm our indication that retail sectors are growing at a good rate. And for the industrial REIT, growth is sustained by policy-driven initiative. We see that AME REIT would be a good pick in this regard, given by its long-standing position in the Johor's market. So it has strong high occupancy and then sticky multinational tenants, as well as good predictable rental rates growth. Overall, the industrial segment is bright, and we see that policy-driven tailwinds like JAS, SEZ, NIMP, NETR would help further improve the likings to this sector. And then beyond near-term core demand like the core logistics, warehousing, and manufacturing spaces, we also see that tenants are moving into a more slightly modern type of industrial. So we can see like automated warehouse, cold chain facilities, and power-ready sites for data centers would be a huge demand in the near to medium term. And then finally, for office, we note that the occupancy is still growing, but not as high as we expected. So it's still at 80%, around 80% occupancy. And we note that the shift of tenants moving away from older buildings to a more slightly modern buildings, given that they meet the ESG standards and has better asset quality, has made some of the older buildings less demanding. Thus, we note that the older buildings are now cutting in prices to entice more people to come in. Against this backdrop, we look at Central REIT as a relative standout, offering the highest yield across our coverage at 8.5%. FY26 would also be able to grow, driven by their new acquisition of retail malls. So they have been slowly diversifying to other asset classes, not just sticking to office. And finally, the disposal of Wisma Inai building, which just completed last week, would help them fund further asset accretive acquisitions. And then finally, on the withholding tax front, we note that there have been a structural overhang on MREIT valuation because of these withholding taxes, particularly for the affected investors, which are the foreign funds as well as individual investors. So if the withholding tax doesn't continue, we expect net yields of dividends would be compressed further by 50 to 100 basis points. Thus limiting the attractiveness of MREITs to this particular foreign funds and individual investors. So they may rotate out to other alternative assets. But despite that, we do not undermine the sector's domestic investment case. MREIT's shareholding remains anchored by GLCs and local institutions, which are not directly impacted by the withholding concessions. So all in all, REIT sector, we expect it to grow on the back of good economics and also a better earnings visibility. Our top picks are AME REIT as well as Pavilion REIT. So that is all from me. Feel free to look at the reports and see you next time. Thank you.